Hi, in this video I'm going to talk about 10 extra things every small business owner needs to know about depreciation beyond the basics. 1. You can't depreciate everything. Only tangible assets with a useful life over 1 year are depreciable. You can't depreciate things like land because it never wears out. Inventory is sold, not used. Lease equipment unless you own it. And small purchases under your capitalization threshold, usually $2,500 or less per item. 2. You must set a useful life. Every asset has an estimated life, usually based on IRS guidelines. For example, computers is 5 years, vehicles is 5 years, office furniture is 7 years, buildings 27.5 for residential, or 39 years for commercial. Your depreciation schedule is built from these timelines. 3. Salvage value matters for straight line. If you expect to sell the asset at the end of its life, you subtract that salvage value before calculating depreciation. For example, the cost is $10,000. The salvage value is $2,000. Life is 4 years, so it's going to be cost minus salvage value divided by the useful life. So that's $10,000 minus $2,000 divided by $4,000 equals $2,000 per year. 4. Depreciation starts when the asset is placed in service. You can't start depreciating the moment you buy it, only when it's ready for use. If you buy a delivery van in December but start using it in January, the depreciation starts in January. 5. Selling or disposing of assets triggers a gain or loss. When you sell something you've been depreciating, you may have to recognize a gain or loss. The IRS calls this depreciation recapture. If you sell it for more than its book value, part of that profit can be taxed as ordinary income. 6. Section 179 and bonus depreciation are optional. These accelerated methods are great for tax savings now, but using them reduces future deductions. If you expect higher profits in the future, you might spread depreciation instead of taking it all at once. 7. Depreciation affects both taxes and bookkeeping differently. Tax depreciation follows IRS rules. Book depreciation follows accounting principles, that's GAAP. They often differ, which is why you'll sometimes see book-to-tax differences on financial statements. 8. Keep detailed records. The IRS can audit depreciation claims, so you'll need purchase receipts, date placed in service, asset description, depreciation method used, useful life, and accumulated depreciation. Without proper documentation, the IRS can deny your deductions. 9. It's a non-cash expense, but a real benefit. Depreciation doesn't cost you cash each year, but it still lowers your taxable income, which saves money. That's why it's sometimes called a paper deduction. It's invisible, but powerful. 10. Repairs and improvements. Regular maintenance is expensed immediately. Major upgrades that extend an asset's life must be capitalized and depreciated. Example, if you're repainting a truck, then you expense it. If you're replacing the engine, you capitalize and depreciate it. Thanks for watching. We'll see you in the next video.